Since the beginning of this calendar till November 11th, the rupee lost 4.4% in value against the US dollar. It was the second worst performing currency after the Japanese yen. In this episode, we will look at the decline of the rupee, the health status of India's exports and imports, and inflation in the country, because all of these are interconnected, impacting each other either directly or indirectly. Stay with us. Hello and welcome back to Business Matters with the Hindu with me, K. Bharat Kumar. On Tuesday this week, we learned that the International Monetary Fund is likely to consider reclassifying India's foreign exchange regime because of the high volatility seen in the rupee. A Bloomberg article on the topic tells us that the rupee has seen far greater volatility under the current RBI Governor Sanjay Malhotra than it did during the time of his predecessor, Shaktikanta Das. Now, what happens when a currency declines in value? Typically, exports from that country become more competitive versus peers. At a time when India is facing such high tariffs from its largest trading partner, the US, and it's not yet clear whether those tariffs would come down, there's a lot of uncertainty around these tariffs. At such a time, a weaker rupee could help our exporters somewhat. But India imports far more than it exports. And the latest trade data shows record trade deficit. This was for October. This means the gap between imports and exports has never been this high. With more imports, the demand for a global currency such as the US dollar goes up in India, and with faltering exports, the demand for the rupee would decline, thus pushing the currency value down even further. In a note it had put out in September this year, ratings and analytics agency CareEdge said that the rupee had been under stress due to US policies. Because of the US's secondary tariffs that took effect on imports from India into the US to take an effect in August, the total tariff burden for India had touched 50%, making it among the most heavily tariffed countries in the world in the current scenario. India's direct goods export exposure to the US is only about 2% of GDP, but higher tariffs could hit competitiveness and impact growth. Sectors such as India's gem and jewelry become vulnerable. Footwear, textiles, and leather may actually lose market share to Vietnam and Indonesia that face lower tariffs. If the 50% US tariffs continue, that could pull India's GDP growth for the current year to 6%. But if the tariffs settle at 15 to 20% after negotiations, then growth could well be touching 6.5%. These concerns are also weighing on funds flows from foreign investors. Till September year to date, the net FPI equity outflows came to $15.9 billion. Such trends tend to put downward pressure on the rupee, because when investors want to pull out their funds from a country like India, they obviously prefer a global currency like the US dollar. So there is a demand for the US dollar, the demand for the rupee goes down, and hence there's a downward pressure.